If you are retired, or if you are anywhere near that finish line of retirement, there is one invisible thief standing between you and the peace of mind you have worked your entire life to achieve. And do you know who that thief is? It is not the stock market. It is not inflation. It is your total lack of a tax plan for retirement. So many of you spend 30, 40, 50 years saving every single dollar you can. You look at that balance in your traditional 401k or your IRA and you say to yourself, I did it. I have $1 million. I am safe. But are you really safe? No, you are not. Because you are forgetting one massive, undeniable truth, that money is not all yours. The Internal Revenue Service is sitting right there next to you as a silent partner in your bank account, waiting for you to turn 65 or 70, just so they can take their slice of your pie. Today, I am answering the most critical, most terrifying tax questions that I get asked every single day by people just like you. Questions that keep you up at 2 o'clock in the morning wondering, am I going to run out of money? Is the government going to take half of my Social Security? What happens when I am forced to take money out? We are going to unpack the fear, we are going to tear down the confusion, and I am going to give you the exact, actionable steps you need to take right now to stand in your truth and protect what is yours. Let us start with question number 1, because this is the question that makes people's blood boil more than anything else. Is my Social Security going to be taxed? I hear the fear in your voices when you ask me this. You say, Susie, I paid taxes on my paycheck my whole life to get Social Security. How on earth can they tax it again when I receive it? I get your frustration, I validate your anger, but we must face reality. The answer is yes. For many of you, your Social Security benefits will be taxed. Up to 85% of your Social Security benefit can be subject to federal income tax if your combined income crosses certain thresholds. Now, what is combined income? The IRS calculates your combined income by taking your adjusted gross income, adding any non-taxable interest, and then adding 50% of your Social Security benefit. If you are filing single and that total is between $25,000 and $34,000, 50% of your Social Security becomes taxable. Do you see how low those thresholds are? They have not been adjusted for inflation in decades. So if you pull an extra $10,000 out of your traditional IRA to buy a car or fix a roof, you do not just pay tax on that $10,000, you might accidentally trigger a tax torpedo that causes your Social Security benefits to get taxed too. Which brings us right into question number 2, how are my 401k and IRA withdrawals actually taxed? People, listen to me. When you put money into a traditional 401k or a traditional IRA during your working years, you got a tax deduction up front. That was great back then. But every single dollar you take out of that account in retirement is taxed as ordinary income tax. Not capital gains rates, ordinary income rates. That money lands on top of your pension, on top of your Social Security, and on top of any rental income or interest you have. The biggest fear I see is people being forced into a higher tax bracket when they least expect it. They think, oh, I will be in a much lower tax bracket in retirement. Will you? If you have worked hard, paid off your mortgage, and accumulated a sizable IRA, your required withdrawals might put you in the exact same tax bracket, or even a higher one. Plus, tax rates right now are historically low compared to where they have been in past decades. Do you really think taxes are going down in the future with national debt where it is? Absolutely not. That leads right into the biggest elephant in the room. Question number 3, what in the world is going on with required minimum distributions, or RMDs? This is where people get so confused and make mistakes that cost them thousands of dollars in penalties. Under the Secure Act 2.0 rules, if you were born between 1951 and 1959, your RMD age is 73. If you were born in 1960 or later, your RMD age moves to 75. What is an RMD? It is the IRS tapping you on the shoulder and saying, time is up. You must start taking a specific minimum percentage out of your tax-deferred accounts every year so we can collect our tax dollars. And if you fail to take your RMD? The penalty used to be a devastating 50% of the amount you were supposed to take. Thanks to Secure 2.0, that penalty has been lowered to 25% or 10% if you fix the mistake quickly within 2 years. But 25% is still a massive penalty for simply forgetting a deadline. So, how do we fix this? What are the actionable takeaways to protect yourself starting today? First, look at the gap years, the golden window between the day you retire and the day you turn 73. In those years, your earned income drops. That is your opportunity to execute partial Roth conversions. Move money systematically from your traditional IRA into a Roth IRA. Yes, you pay tax on the converted amount today while you are in a lower bracket. But once that money is in a Roth IRA, it grows completely tax-free, withdrawals are tax-free, and guess what? Original owners never have to take RMDs from a Roth IRA. You take control away from the IRS and put it right back in your own hands. Second, if you are 70 and a half or older and you donate to charity, use a qualified charitable distribution, or QCD. You can transfer money directly from your traditional IRA to a qualified charity. That money satisfies your RMD requirement, but it never counts as taxable income on your tax return. It keeps your adjusted gross income low, protects your Social Security from being taxed, and helps a cause you care about. Third, pay attention to your withdrawal order. Do not just pull blindly from one account. Coordinate your taxable brokerage accounts, your pre-tax IRAs, and your tax-free Roth accounts strategically each year to keep yourself at the very top of a lower tax bracket without spilling over into the next. You have worked too long and sacrificed too much to let fear, ignorance, or poor planning ruin your financial future. Face your numbers, understand your tax brackets, take action today, and protect your peace of mind. You can do this.